What's happening with the U.S. economy? Are we on the brink of a larger economic crisis? Could the Biden administration's actions worsen the situation? Or are these decisions a calculated move against global competitors? Let's break this down step by step and uncover the consequences of recent actions that could change the global economic landscape forever. The U.S. markets are on edge, with a sharp sell-off causing unease among investors. Analysts believe this may just be the beginning, as the Biden administration's recent moves have baffled critics and supporters alike. The administration seems determined to push forward with controversial economic decisions, even as its time in power potentially nears its end. With fewer than 10 days left until the much-anticipated second coming of Trump, the pressure is mounting. Biden's actions, however, may leave a legacy that will be difficult for Trump or anyone else to reverse. These moves could accelerate a decoupling between the U.S. and China, potentially triggering long-lasting consequences for Western economies. The most recent and bold move by the Biden administration involves adding the major Chinese corporations, Tencent and CATL, to the U.S. blacklist. This designation identifies them as Chinese military corporations, raising questions about the criteria being used. Tencent, widely known as the world's largest video game publisher, and CATL, a leading supplier of EV batteries to companies like BYD and Tesla, don't seem like traditional military-linked firms at first glance. The administration, however, appears to classify nearly all Chinese industries as potential threats. This aligns with the broader trend of economic decoupling, where the United States seeks to reduce its dependency on China in various sectors. But what does this mean for the global economy? The old globalization model, where businesses from different countries could freely trade with one another, is now being replaced by a more fragmented and protectionist system. On the surface, this may sound like a way to strengthen domestic manufacturing and protect national interests. However, it could lead to significant setbacks for all parties involved. Chinese companies like Tencent and CATL will undoubtedly face profit losses if denied access to U.S. markets. But American companies won't escape the ripple effects either. To compensate for the loss of Chinese imports, American businesses would have to ramp up domestic production. While this sounds patriotic, it comes at a steep cost, as higher manufacturing expenses could lead to increased prices for consumers. As of now, 130 for Chinese companies are on the U.S. blacklist, a staggering figure that highlights the Biden administration's aggressive stance. Among the most notable names are Tencent, China Mobile, the country's largest telecommunications company, and Sinopec, the main oil company in China and one of the largest oil importers globally. The implications for these corporations are dire. Being blacklisted doesn't just mean strained business relations with the U.S. It also signals a loss of credibility and trust in global markets. Investors may hesitate to put money into these companies, fearing potential sanctions or restrictions. For example, CATL, the world's largest EV battery producer, stands at the center of this conflict, with a dominant market share that surpasses the combined output of Japan and South Korea. CATL has been pivotal to the EV revolution. The company's partnerships with firms like Stellantis to build a multi-billion-euro battery facility in Spain underline its global influence. If the U.S. chooses to weaponize this blacklist further, restricting other nations like those in the European Union from collaborating with CATL, the fallout could be catastrophic. European EV prices might skyrocket, making electric vehicles unattainable for many consumers. This would cripple the EV industry's growth and put Europe in a position where it either complies with U.S. demands or faces economic retaliation. Will Europe sacrifice its own economic stability to align with U.S. policies? This remains uncertain. However, if the EU does give in, they may be left with only one option: importing expensive batteries manufactured in the United States. Such a move would drive EV prices in Europe to unsustainable levels, potentially quadrupling costs and halting progress in the green energy transition. Kishore Mahbubani, a former Singaporean ambassador, has already warned that such actions could harm the United States in the long term, leading to a loss of global influence. As countries seek alternatives to align with their economic interests, the consequences extend beyond EVs. The Biden administration's efforts to isolate Chinese firms could unintentionally strengthen China's dominance in the global battery market. By 2030, Chinese companies like CATL and BYD are projected to control over 70% of global battery production. Meanwhile, the U.S. is expected to produce less than 15% and at a significantly higher cost. If the rest of the world chooses to align with China rather than the U.S., the long-term repercussions for American industries could be severe. Beyond the battle with China, Biden's administration is also doubling down on sanctions against Russia, focusing on its energy sector. Over the past 2 years, G7 nations have tried to weaken Russia's economy, but the results have been underwhelming. Despite sanctions, Russia's economy is projected to grow, with positive GDP rates outpacing many EU nations, backed by trade with China, India, and other BRICS nations. Russia has managed to stabilize its economy even amid heavy sanctions. Most recently, the U.S. Treasury introduced a sweeping set of penalties targeting Russian oil producers, service providers, and cargo ships. The goal is clear: cut off revenue streams to Russia and weaken its economy. However, the effectiveness of these measures is questionable. While sanctions create short-term disruptions, Russia has adapted by developing a shadow fleet of oil tankers to circumvent Western restrictions. Data shows that Russian oil continues to flow to major importers like China, India, and Turkey, underscoring the limitations of Western sanctions. The Biden administration faces a critical challenge. While its aggressive stance against China and Russia might seem like a display of power, the long-term effects could undermine U.S. economic stability. Rising oil prices, for instance, have already begun to impact global markets, with Brent crude prices climbing nearly 4% recently. As energy costs rise, economies worldwide will feel the strain, further complicating efforts to achieve global economic recovery. In the end, Biden's economic policies might leave more questions than answers. Is the pursuit of geopolitical dominance worth the cost of higher prices, strained alliances, and potential isolation from key global markets? As the U.S. continues to push for decoupling from China and sanctions on Russia, the world watches closely. One thing is certain: these decisions will shape the global economy for years to come, with consequences that extend far beyond the Biden administration's time in office.